My name is Tim Hamilton, and welcome back to part 3 of my discussion on student loans and what you need to know in 2021. This presentation is part of my larger Planning on Call blog, podcast, and video series focusing on providing medical professionals and their spouses the important information they need to know as they plan their future. Just to mention again, this presentation on student loans should help anyone with managing their student loan debt, no matter their profession, especially those that do have large debt levels due to extensive postgraduate education. So before we move on, I do just want to add a few quick notes about me and my firm, Atlas Private Wealth Management. I'm a Senior Vice President and Wealth Management Advisor here at Atlas, and also a Certified Financial Planner and Certified Student Loan Professional, among other financial designations. I've been working in financial planning for over a decade, and in my current role, I work with over 200 families, helping them plan their financial lives. As for my firm, Atlas, we're a fee-only financial planning firm based in New York, having formed back in 2014. We help individuals with financial planning, investment management, tax preparation, and very importantly, we are a fiduciary firm and are required to always act in our clients' best interest. Lastly, I would also like to note that all situations discussed in this presentation are for illustrative purposes only. Numbers are estimated, interest rates are assumed, and each specific situation is very fact dependent. So you should reach out to an advisor for help with your personal situation. Okay, and just as another quick reminder, today's section, part 3, is the third section of a 3-part series. The first section focused on just a broad overview of student loans. Section 2 focused on federal student loan forgiveness program. And for this section, I am very, very excited to do something a little bit different. Today, I'm having my friend and colleague, Lonnie Lee, on. Lonnie is the marketing coordinator at Atlas, and I like to say the actual skill behind planning on call. Lonnie will be presenting me with 3 student loan cases that she put together from situations we've had at Atlas with clients. And so what I'll do is I'll walk through each repayment scenario and how we would handle each situation, and Lonnie will ask me questions relating to each scenario. So with that, what I'll do is I'll turn it over to Lonnie and she'll present our first hypothetical.
All right, everyone. Hi, I'm Lonnie, and our first case study is Kyle. So, as far as Kyle's background goes, he has completed undergrad and he did that in 2012. He worked in the private sector for 4 years and returned to medical school from 2016 to 2020. Kyle is also single. A couple of his goals: he plans to follow a 5-year hospitalist residency and fellowship to eventually land a position in his rural hometown. As far as his pay, he's looking for and hopeful that his final position will pay $10,000 a year towards his loan as an incentive for his employment. And he is looking for love. We've got Kyle from The Bachelor here. He would like to be married. So some of the planning that's going on with this is going to have that in mind. So Kyle's got loans. You know, Kyle was a med student. He's got federal, FFEL, and direct loans, $200,000, and an average interest of 6%. His private loans total $50,000 at an 8% interest rate. His residency and fellowship salary is $55,000, and his expected attending salary is $150,000. So we've got some questions to throw back at you, Tim. Should Kyle enroll in an IDR plan?
Great first question. And the answer is yes. Why? So I always look at 2 things in terms of why do you enter an IDR plan. So the first is, do you need to lower your loan payments? What an IDR plan will do is it will tie your payments to your income rather than the amount of loans that you have. Kyle earning $55,000 a year and under a standard federal repayment of $26,650 and private loans at $7,250 per year, it's going to mean that he really will not have probably enough pay to even live on, especially if he's in a higher cost of living area like a New York City, San Francisco, Philadelphia, something like that. So, from a needs standpoint, does he need to lower those loan repayment amounts? Probably. So, an IDR plan would probably be good. The other thing we look at is, can Kyle get into the public service loan forgiveness program? Again, just a reminder of what that looks like from section 2. Kyle would need to make 120 monthly payments under an IDR plan and be working for either a government entity or a nonprofit, a qualifying 5013C, to get his loans completely repaid in 10 years, 120 months, and the amount that's repaid is not going to be taxable to him. Under the regular IDR plan without the public service loan forgiveness, it actually takes 20 to 25 years to get those loans repaid, and the amount that's paid off is taxable. So it's really not very advantageous. But if you can take advantage of the PSLF, Public Service Loan Forgiveness Program, it's very advantageous to do that. Kyle, working in residency for a hospital, in fellowship for a hospital, and then planning to go home and work for a hospital, does seem to be an ideal candidate to take advantage of this, because hospitals usually are a qualifying entity for the PSLF program. So yes, Kyle absolutely should look at taking advantage of an IDR plan.
All right. So my next question for you is, which IDR plan should Kyle choose?
So this question actually is gets pretty into the weeds. So I wouldn't mind actually showing some of the calculations behind how we come up with this. So if you wouldn't mind, Lonnie, I think I'm going to share my screen and just pull up an Excel sheet to just walk through how we make some of these choices. So here we have an Excel sheet that I would use to come up with the payment that Kyle would need to make. But before I do that, I just want to again go back to the second section that we had on our loan series here and just talk about the different IDR programs that are available. There's the ICR, IBR old and new, payee, and repayee. So there's really 5 different programs. Now, the ICR, that's the original IDR program that we really don't use unless you have Parent Plus loans, because it's really not very advantageous. So we're not even going to look at that one. But looking at the IBR old and new payee and repayee, I just want to walk through how these are calculated. So the way that we find the amount of repayment he'll have, we're starting with income. So that would be in residency and fellowship, $55,000. From gross income, we're taking off any above the line deductions. And the major one you'd see would be contributions to retirement plans, employer retirement plans. We'll assume for this initial scenario that Kyle is not contributing anything. So therefore his adjusted gross income would be 55,000. From that, we're taking off the federal poverty line, 1.5%, or I'm sorry, 150%, or multiplying the federal poverty line by 1.5. And usually for an individual, that federal poverty deduction here is $12,000, and then about $4,000 per family member. And just as a reminder, spouses are a family member as well as kids. In this case, Kyle is single, so it would just be $12,000 times 1.5. So his federal poverty line deduction would be $18,000. So he's looking at discretionary income of $37,000. In the old IBR plan, what we would be doing is multiplying the discretionary income by 15%. And this is how you find the annual payment amount for Kyle under an old IBR plan. And we can see that the amount is $5,550 per year, or $462.50 per month. And again, taking a look at the standard repayment, which would be over $26,000 per year and over $2,000 per month, we can see just how huge of a benefit it is to use these programs. We're talking thousands of dollars a month in a lot of cases. So again, definitely good to use an IDR program, and it's $5,550 under the old IBR program. Now let's take a quick look at payee and new IBR. So these are found the same way as you find the old IBR. The only difference is that you are going to multiply the discretionary income that Kyle has by 10% instead of 15. So again, it's just even better. And you can see now we've lowered his annual amount all the way down to $3,700. Very, very advantageous. The thing about payee and new IBR, though, is there are a lot of restrictions in terms of can you be in these plans. It's really time limited. New IBR, you have to have loans after 7/1/2014, and pay as you earn, you have to be a new borrower after 10/1/2007 and have loans after 10/1/2011. Luckily for Kyle, he does have loans that allow him to be in the payee program. So I would lean towards using the payee program. Now, the last thing I just want to mention is the repayee program. Repayee, this is actually the default that you're usually put in if you go into an IDR program. So what's nice about the repayee is you see it is using that 10% of discretionary income. But Lonnie, you had mentioned that Kyle is looking for love. And the tough part about the repayee program is that if he does get married, he will have to include his spouse's income in this calculation. And that will be very, very impactful. So let's say Kyle marries someone that is making $100,000 a year. So in this case, now his gross income is up to $155,000. And what does that do? His loan repayments go from $3,700 per month to $13,700 per year. Very, very impactful. So we probably want to use the plan that he will not need to include a spouse if he gets married. And so in this case, I think he's perfect for the payee plan. Another quick downside I would mention about the repayee is that repayee is also the only plan that does not have a cap on the repayment of your standard payment amount. So we see that Kyle's standard repayment is $2,220. That means even if Kyle's making $1 million per year under the IBR and payee, both old and new IBR, he can't pay more than $2,220 per month. Again, even if his income goes up to be very, very high. So repayee, I can be good again because of that 10% of discretionary income. But if you're able to get into the payee or new IBR, I would lean towards that. So as a long-winded answer, payee would be the route to go for Kyle.
All right. So the next question for you, Tim, is what should Kyle do before enrolling in the payee IDR plan?
So, very simple step in terms of all the answers I had. Really, just one big thing, but it is very important. Kyle is going to need to consolidate his loans. And this is because Kyle has FEL loans, FFEL loans. FEL loans existed before 2010. Now everything is in the direct loan system, but you cannot have FEL loans and have them get forgiven through the Public Service Loan Forgiveness Program. So Kyle will need to consolidate those loans. As a reminder, you can only consolidate the federal loans. And the way those are created is they just all go into one loan, and the interest rate will be the weighted average of the interest rates of all his other loans.
All right. Well, then, should Kyle consider taking advantage of his 403B?
Yes, he should. So we noted that Kyle will be in the payee system. So let's start in the payee system here. And let's just take a look at what happens if he is contributing to a pre-tax retirement plan. Now, just a little background on what that is. So that is going to be a retirement plan that's through your employer. Sometimes it's a 401k, sometimes it's a 457. A lot of times what you see at hospitals is it's going to be a 403B, and sometimes you'll have a supplemental 457 you can add to too. Let's keep it simple and just say that during fellowship and residency, Kyle can contribute up to the maximum $19,000 as an employee that he can contribute to a 403B plan. So, what does this do to his loan repayments if he contributes to a pre tax retirement plan? Now his adjusted gross income goes down to $36,000, and therefore his annual pay amount is going to be $1,800, considerably less than $3,700 per year. So this is great because what you're doing is you're saving into a retirement plan, what you should be doing anyway, and you're getting a benefit of paying a lower amount to your loans as well. A few quick notes on this though. First off, make sure that you're contributing to a pre tax retirement plan. You can contribute to a Roth plan, and what happens with a Roth plan is that you're paying taxes up front, but then things are growing tax free, and when you take assets out, it's tax free. You don't want to do that because you're not lowering your income amount. You want to be putting money in pre-tax, meaning it's not taxed up front, grows tax free, but when you take it out, then it's taxable because you need to lower your income to have it affect what your loan repayments are. Another thing that I would note, having gone through this with my own wife, is if anybody listens to this, my wife is a plastic surgeon. Going through residency and fellowship, it's a difficult time from a pay perspective, and $36,000 a year can be difficult to live on. Again, if you are in a higher cost area, again, New York City, something like that. So it's a very difficult time. Uh, I think that mental health is very important through residency as well. If you have a time for a vacation, take it and go somewhere nice that lets you get away. If you want to live in a place that you feel very comfortable when you get out of the hospital at the end of the day, I think that's important. So if you're not able to put the full $19,000 in through residency and fellowship, honestly, I think that's okay. But I think that when, let's take Kyle, let's say when he does start making $150,000 a year as an attending, should he be taking advantage of the retirement plan then? Absolutely. And he should be focusing on maxing out at this point. And again, he's going to be in a rural area. It's going to be a little bit lower in terms of how much it costs to live. So absolutely, he should be taking advantage of this. So we can see that if it's zero, his loan repayment is $13,200 per year. What's that do when he maxes his retirement plan? It brings it down by about $2,000 per year. So you're maxing the plan out, doing what you should do, and you're getting $2,000 off your loan repayments. That's great. Another quick thing I would note is that I mentioned usually in hospitals, you have the ability to not only contribute to a 403B, but also a supplemental 457 plan as well, depending on the hospital. If that's an option and you can put a full $38,000 in, it can be super, super impactful. And again, something I would really recommend doing on a pre tax basis. Now you're bringing down your payments by about $4,000 per year. So, definitely, especially once you become an attending, really focus on putting as much as you can to those pre tax retirement plans. So, thank you for letting me take over again there. I'll throw it back to you, Lonnie.
All right. So thank you for that explanation, Tim. So that gives a little bit more so you can see it right in front of yourselves. Also, if you're taking notes along with us here. So question number 5 on Kyle. What should Kyle do about his private loans?
Yes. So, the private loans, one thing to note is that the private loans, there's nothing you can do about those. You're going to have to be paying those throughout. And therefore, what you should really do, especially once he becomes an attending, is make sure that any extra cash flow you have that you're going to be putting towards loans, it's going to the private loans. And when he becomes an attending and has that extra $10,000 bonus, the incentive that he has, definitely make sure that that's focused towards the private loans. And this is something that you see again looking at more rural areas that has sometimes had a little bit more trouble attracting doctors, you're going to see certain incentives like this. And again, it's very important to put the loan payments towards the private loans first, because when you're in an IDR program and trying to get that public loan forgiveness, there really is no benefit to paying down the actual loan amounts any more quickly. It's all based on what your income is.
So that's a wrap for Kyle. Next up, we have Madison and Casey for case study 2. So Casey is in her second year of orthopedic surgery as a resident, and Madison is a marketing executive, and they are married. Goals: Casey plans to join Madison's mother's private practice after completing residency. All right. So as far as loans go, Casey has several loans totaling 350,000, 250,000 of which are federal loans, split between direct loans at an average interest rate of 5.5% and FEL loans at an average interest rate of 7.5%. Her 100,000 of private loans are at several different banks and range from 6 to 8%. Madison has 0 loans. Current salary for Casey, you're looking at 60,000 and Madison at 150,000. Casey expects this to increase substantially, going to 500,000, with Madison maintaining at 150,000. So next up, we've got some more questions for you, Tim. Should Casey enter an IDR plan?
So let's go back and ask the same questions we did with Kyle. First off, from a cash flow perspective, is this needed? Now, the difference that we're seeing with Casey and Madison is that Madison is adding to the income of the couple, and she has no loans. And at $150,000, it's a pretty good income. So I would look at this and say, it depends what their goals are, but it is a possibility that they can repay this given what they make. So I don't know if the need is there like it was for Kyle. So that may not be a reason to do an IDR repayment. And then the other piece is, can Casey take advantage of the Public Service Loan Forgiveness Program, PSLF? No, she cannot, because we know that she's going to go into private practice after graduating residency and fellowship. Therefore, she will not get to the 10 years, 120 monthly payments within the PSLF program, and therefore it doesn't make sense. The only way it would make sense for Casey is if, let's say, she was going to do multiple residencies and fellowships that may last for over a decade, but that's not the case. Therefore, I would probably not recommend them entering an IDR program for Casey's loan repayments.
So should Casey consolidate her loans then?
Well, in this case, actually, I would look and again do things a little differently than Kyle. So if you consolidate your loans, there's 2 routes. You can go the federal route, and all that's going to do, as I mentioned, is consolidate things into one loan, but it's just the weighted average of your loan, so you're not getting any benefit really from an interest rate standpoint. And then you can also consolidate in the private sector. Now, if she consolidates everything privately, there's a few things she needs to think about. First off, you're never going to be able to have your loans repaid. You can't go private and then bring it back public. So there's that worry. And also there's some definite benefits in the public with public loans, federal loans. If you were to pass away, those loans are going to go away. If you are to become disabled, those loans are going to go away. Some of those protections don't always apply to private loans. So with a private loan, you need to make sure that, are we looking at life insurance? Are you going to need to take out more life insurance, more disability insurance? But with that said, given Madison and Casey are a little bit older now, Madison makes a good amount of pay. Maybe they have good credit at this point. So it may be the case that Casey can actually go and get a fairly low rate through a private lender, especially when interest rates are as low as they are right now. So it may be that she could get a very attractive rate on a private consolidation. So it may be something she wants to look at. But again, she just needs to consider, okay, do I need to factor in maybe buying some extra life insurance and things like that if she goes a private loan route? Oh, and one more thing to note, federal loans, again, can be consolidated into the private system. They just can't go back. Private loans cannot be consolidated into the federal system.
Good to know. So, which loan should Casey target paying off first?
So this question actually is another reason why I definitely would not consolidate even the federal loans, because when you have many different loans, and if you do decide to try to repay those loans a little bit more quickly, so going above what the standard payment is, and that's definitely going to be, I think, something that Madison does once her income jumps up. So what you'd want to do is definitely target any extra payments towards the highest interest rate loans first. So you pay the standard payments on everything, and then as much as you can towards the highest interest loans first, and then once that's paid off, you continue to just move down the list until you get to the low interest rate loans.
Okay. That makes a lot of sense as a person who is in repayment herself. Where should Casey and Madison be directing excess cash flow?
Yeah, so this question's a really good question, and it really hits on just general financial planning as well. What you want to be doing is taking advantage of long-term rates of return in retirement plans, and then again taking a look at what interest rates you're currently paying. So first off, what they're going to want to do is, especially for Madison, I'm sorry, yes, especially for Madison, who is not at a hospital, she probably has some type of match through her retirement plan. So definitely focus on, first of all, always get the match that you can through your employer, the match in your 401k, because that's money that wouldn't be there if you didn't put money into the 401k. Another thing that's really important is to take advantage of using Roth vehicles. So I'd mentioned with Kyle not to use a Roth because it's going to be bringing down his loan repayments. But with Madison and Casey, who are not going to be taking advantage of the PSLF program, while Madison is in residency and fellowship, they're going to be in definitely their lowest income rate, lowest income environment for really probably until retirement. So putting money in, taxing it now so that it's not taxed later, is probably a good idea. So they're going to want to look at taking advantage of Roths if they're able to. They're going to want to take advantage of, as I said, at the bare minimum, the match in the 401k. And Casey may want to look at taking advantage of a 403b as well. Many times in hospitals, there's not a match, but it's still something where she may want to look at a 403b, especially if she is able to pay off some of those higher interest rate loans. And then when you're looking at the lower interest rate loans, sometimes it really is more advantageous to take advantage of retirement vehicles, because you would hope your long-term rate of return is going to be better than the interest rate you're paying.
So, we're moving on to Ron and Nicolette. So, case study number 3 here. Nicolette has 2 more years before completing their plastic surgery residency. Ron is a nurse. They're married with 1 child and 1 on the way. As far as goals, Ron plans to stay in the same state hospital system long term, while Nicolette would like to find her ideal environment, hospital route or private practice. All right. So, as far as their loan situation, Ron and Nicolette both have all federal direct consolidated loans. Ron is sitting at 120,000 while Nicolette is at 300,000. Nicolette has loans beginning in 2006 and ending in 2014, while Ron's begin in 2008 and end in 2014. And the average loan rate for both of them is at a 5.5% interest. So Ron's current salary is 80,000, Nicolette's is 50,000, and the expected salary is supposed to maintain for Ron, in this case at 80,000, and Nicolette's to increase to 200,000 if she stays the academic route versus 500,000 if she goes the private practice route. So another set of questions. Tim, you ready?
Let's do it.
All right. So, what IDR plan should Nicolette and Ron enroll in now?
So I really like this case study because I see more of this than honestly the first two, where individuals know exactly what they're going to do after residency and fellowship. I think Nicolette is a very common case where even if you think you may want to do private practice or you may want to go more the academic route, a lot of times individuals don't know exactly what they're going to do. So deciding what they should be doing now can be difficult. So, first off, I would just note that Nicolette and Ron should be in an IDR plan because I do lean towards taking advantage of the IDR plan because it's so impactful taking advantage of the IDR plan versus, and if you stay in the hospital route versus not. And just to go quickly back to Kyle, I just want to note a few things. So with Kyle, let's say he did take advantage of the PSLF program using the payee route. And let's say he put $19,000 per year once he was an attending into his 403B. That results in over $200,000 in savings versus him going the route of just paying off his loans. So using this IDR plan is so impactful that I do really think if you don't know what you're going to do, I would err on the side of using the IDR program. And then if you go private, you can just focus on trying to pay those off a little more quickly at that point. So with that said, I think that both Nicolette and Ron, even though Nicolette may not know if she's going to take advantage of this long term, I think it's good for both of them to get into the repayment program. So a few things that we're going to look at. Again, we don't want to use the old IBR if we don't have to, but we look at somebody like Nicolette who has loans dating all the way back to 2006. So therefore, she is going to not be eligible for the new IBR or the payee. So for Nicolette, we're just looking at repayee or we're looking at old IBR. Now, she is married to somebody who's making a decent salary. So you may think, oh, we don't want to use the repayee. But because Ron is also in this system, his income is going to be included no matter what anyway. So in this case, actually, the repayee is the better route to go. And that's because they will get the 10% rate for both of them, and their income is both going to be included. I just want to quickly show you how we would arrive at this number, because when you have two individuals that are in the IDR program, it's a little odd how we come up with the numbers. For these two individuals right now, their income is going to be $130,000. For this base example, we're not going to assume they're putting anything into their retirement accounts. And very importantly, you are going to include both of them in the family calculation plus their child. And as you mentioned, Lonnie, they have one on the way, which also counts as an active family member. So we're looking at 4 family members, which is really going to increase that federal poverty line. So we're looking at bringing the loan payments all the way down to $9,400 per year, or $780 about per month. Whereas under the standard repayments for both of them, you're looking at $40,000 to $50,000 of loan payments per year. So definitely easier to live off of inside of the IDR program, especially with 2 young kids. Again, repayee is, I think, what you would want to do. Now, the other thing I would just note is one thing you'll notice here is that Nicolette is, even though their total repayment is $9,400, Nicolette's share of that payment is $6,700, whereas Ron's is $2,700. That seems a little odd because Ron's income is actually more. But the way it works with a spouse is it's based on the loan amount. So if you're taking 2 individuals with loans, putting it together, it's actually the weighted average of those loans in terms of how the repayments are split between those 2 individuals. So I just wanted to note that because it can be a little confusing. Whereas finding the actual number, it's not too different from what we did with Kyle. So Sorry, another long-winded answer there, but I think they should start with repay, Lonnie.
All right, fair enough. Nuanced situations. So, with their particular circumstance, then, how should they consider filing their taxes?
So I had mentioned when we talked about Kyle the ability to exclude a spouse's income. So the way that you do that is you actually file your taxes married filing separate instead of married filing joint. So the reason I mention this is because married filing separate is not very advantageous. The tax tables are actually a little bit worse when you're married for married filing separate. Also, you're not allowed to take advantage of some deductions and your ability to put things in certain retirement plans. So, married filing separately, you really don't want to use that unless you're actively trying to exclude your spouse's income from this loan repayment calculation. Um, I'll anecdotally just say, like with my wife and I, we were doing married filing separate. Since she's become an attending, now we're to a point where her loan repayments are up at her standard loan repayments. So basically, it doesn't matter if we do married filing separate or married filing joint. So we moved back to doing married filing joint this year, and it saves us over $4,500 on our taxes. So that can be pretty impactful, but it doesn't compare at all in terms of if I was bringing my income originally when she was making residency and fellowship income into the calculation. So these are things that you definitely want to think about, and you may want to be moving back and forth from married filing separate to married filing joint. For them right now, definitely do married filing joint.
All right, so thank you for that, Tim. So we've got our third question here for Nicolette. So does Nicolette's employment decisions change their ideal IDR program and tax filing status depending on if she's chooses working in a hospital or private practice?
So yes, absolutely, it does. If she decides to go the academic route or just wants to work in a hospital, uh, pretty simple. They're going to stay in that repayee program. It's still going to be under their standard repayments given her income. Uh, $24,400 staying in that repayee program. Going to continue to want to take advantage of doing married filing separate. And definitely once she starts making money, I would recommend that they are both maxing out their 403B to try to bring down those loan repayments. So that's not too complex there, but I think where you do see some complexity come in is if she decides to go the private route. If she decides to go the private route, what we're going to want to do is actually uh, take advantage of the Ron being able to use the payee program because his loans are after 10/1/2007, and also he has loans after 10/1/2011. So what we would do is Nicolette, she no longer has any advantage using the IDR program. Her income has gone up considerably because she's in private practice, and she's just going to drop out of the program and start trying to repay the loans, probably more aggressively. And Ron will want to stay in the program, but he's going to drop out of the repayee program and he is going to move over to the payee program. And within this payee program, what that will also allow him to do is exclude Nicolette's income by now doing married filing separately. So as you can see, by doing this move, Ron's payments are $4,400, considerably less than if they stayed in the repayee and had to take into account Nicolette's income. That way, in that way, his loan repayments would be $15,500 a year. Or even if he does the old IBR with 15% of discretionary income, which would mean his loan repayments would be $6,600. So move to the payee and do married filing separate, and it's going to be much more advantageous for that time that Nicolette is now working in private practice and he is still working in the hospital. Um, just a note there, you can do that because with the public service loan forgiveness program, you just have to have 120 payments in an IDR program. It does not need to be the same IDR program. So you can do that. So definitely something that I think Ron would want to take advantage of. The other thing that would be very important is even though Ron is making this point a lot less than Nicolette, make sure that Ron is taking advantage of all the retirement vehicles he can because again, he's the one that's going to be getting even more incentive by lowering his loan repayment amount by putting money into pre-tax retirement vehicles. But given Nicolette's income, she's probably going to want to be maxing out her retirement plan, and Ron probably will as well too.
All right. So, some final thoughts from you, Tim.
Yeah, so what I really hope came across through this presentation, these case studies, is that loan repayment can be really complex, especially when you're talking about large amounts and any type of repayment. And honestly, there's a lot of missteps that can happen. Consolidating when you shouldn't, using the wrong forgiveness plan, not filing your paperwork correctly, which loans do I repay first? So just the loan part, I think, can be maybe more complex than individuals realize. So I hope that came through in these case studies, that it is something you really need to think about and know what you're doing when you make these decisions. The other thing I think that's really important to hopefully take away from this presentation is that loans should not be viewed in a vacuum, especially again when we're talking about very large amounts that a lot of doctors have. You need to be really taking tax planning into account. How am I filing my taxes? Retirement planning. Which investment vehicles am I using? Should I be using a Roth or not a Roth? Insurance planning is important. Again, are these loans where I need to take out an extra life policy or disability policy? So really, loans, especially at a large amount, it's going to impact all of your financial planning life, and it's just very important that I think you are working with somebody that knows what they're doing. And at the end of the day, doctors, especially heavily indebted ones, are going to be playing some catch up. Honestly, my wife and I are included in that. You really don't start doing a lot of the major life steps until you're in your mid 30s. Buying a home, saving aggressively for retirement, starting a family. So these are all things that are happening under at least a relative basis on a compressed timeline. So it's just really important that you're being very, very efficient with your planning, especially in your early years. So I think where a lot of people may think, well, I'll use a financial planner or a wealth advisor once I have an established amount of wealth. But it really is super impactful and important to start some of this early. So I do hope that came across in this presentation.
Well, thank you, Tim. I know I learned a lot, so hopefully those watching learned a lot as well.
Great, great, great. And yeah, so thank you for watching. And if anyone has any questions, please don't hesitate to reach out to me. My number and my email is on there. And like I said, I think that this is a really important topic and something that can be really impactful for young doctors. So please don't hesitate to reach out to me if there are any questions.